In the last few weeks, we have seen a lot of different news around SoFi's stock. Not only did the company report their earnings back on April 29th, showing an EPS beat of 94% and a revenue beat of over 4%, we've also got some very strong insight into the long-term strategy of where SoFi is planning to head in the future. So in today's video, we are going to be taking a look at specifically SoFi's strategy for long-term member growth and how ultimately this will lead to increased profitability. So if you enjoy the video, make sure to drop a like down below, and if you want to see more videos like this one, subscribe. Before we jump into SoFi's long-term strategy, I think it's important to understand where the stock is at. Over the last 6 months, this company has traded sideways. We can see that back in January, it peaked at a price of just over $18 per share. However, it fell all the way down to around $9.50 in April, but from that time period, we have seen almost a 50% rebound to a current stock price of around $13.50. However, if you bought SoFi's stock a year ago, it is currently up almost 100%. However, over the last 5 years, we have seen a tremendous amount of volatility around SoFi. It has constantly been going up and down around earnings, and at one point was trading around $4 per share. From that time period till now, we have seen very strong returns of over 200%. Currently, SoFi has a total market cap of around $15.4 billion. And the reason I show you all this is because I think it's important to consider this versus the banking sector as a whole. JP Morgan is the #1 player in banking. Over the course of the last year, they are up around 30%. So SoFi has returned around 3 times as much over the last year. If we look at the last 5 years, however, JP Morgan is up over 200%. That is a very significant return. And at that same time, the market cap on JP Morgan is currently sitting at $743.6 billion. So there are 2 key takeaways from all of this. One, the banking sector over the last 5 years has been in a very strong position, and this has certainly helped SoFi out. But the second thing is, with a market cap of over $700 billion for JP Morgan, there is plenty of room for growth in the banking industry. SoFi could increase their market cap by 5x and they would still only be a tenth of the size of JP Morgan. And the reasons that I point all of this out is because of where SoFi is trying to position themselves to capitalize on the banking industry over the next 5 years. Anthony Noto actually talked about this strategy at the JP Morgan Global Technology Media and Communications Conference. What he said is that the company is guiding for over 30% annual member growth and mid to high 20% revenue growth while maintaining the goal of reaching 50 million members within the next 5 years. With the current United States population of 340.1 million people, this would equate to around 15% of the United States using SoFi's platform in one way or another. And when you put it in terms of the United States population, that feels like a very high growth target. And certainly it is. However, one thing to keep in mind is that the company right now already has almost 11 million members. That means they already have access to around 3% of the United States population. And on top of that, SoFi's growth rate in terms of members over the last 5 years has been well over 50%. They went from 1 million members in 2020 to now over 10 million members in 2024. That means they have been able to 10x their numbers over the last 5 years. If they can only 5x their numbers over the next 5 years, then they should be able to reach 50 million people. And this is what SoFi's growth over the next 5 years would have to look like to reach 50 million members by 2030. Again, in 2024, they hit 10.1 million members. They're already almost at 11 million members as of Q1 of 2025. However, by the end of 2025, they need to grow by around 30% up to at least 13.2 million members. And then we need to see that 30% growth continue for the next 5 years for them to hit that 50 million member mark. And based off their current growth trend, I think that this target will be very difficult to achieve. In 2022, their year-over-year member growth was 51%. In 2023, it dropped down to 44%. And then in 2024, it dropped by another 10% to 34%. What I I personally think is more realistic is SoFi averaging member growth over the next 5 years of around 23%. What that would ultimately lead to is them having around 35 million members by 2030. I think at the end of the day, they could see 30% growth for the next 1 to 2 years, but I think in 2027 and 2028, they may see their member growth drop down to around 25% and then to around 20 to 15% in 2029 and 2030. Right now, SoFi is doing a great job of focusing on both top and bottom line numbers while continuing to grow their member count. However, if we start seeing growth rates drop off, I do think they may have to pull back on some of their focus for improving their bottom line numbers. Right now for 2025, they have guided for EPS of around 27 to 28 cents. Long term, in my opinion, I think this would be the right strategy because at the end of the day, if they can grow their members, what they can ultimately do in the future is switch back to focusing on profitability. Right now, however, what they may need to do is give up some profitability in the short term by potentially offering promotions on SoFi credit cards or bank accounts or loans, whatever it may be, to get more people into their ecosystem. And ultimately, growing their member count and getting people using their different platforms is going to be huge for the company in the future. I made some comments on this in a past video, but I think what SoFi is trying to do in terms of long-term strategy is position themselves as almost a banking social media company. And ultimately, what I mean by this is SoFi is trying to grow their member count because what they can do in the future is they can drive different products to those members, whether it's their own products or even products from other banks or credit unions. And this is ultimately a similar approach to what Facebook has done. They grew their member accounts, and then what they ended up doing is driving advertising to those members. And this is a high margin, low risk strategy that Anthony Noto recently talked about in a CNBC interview.
We have more demand for our loans than we can fulfill ourselves. So some portion we'll do ourselves and some portion we'll do on behalf of third party. So the loan platform business is really a fee-based business where we leverage our origination platform, our marketing platform, our servicing platform to underwrite loans for other people like Blue Owl and Fortress.
Well, that's what I was going to say. So you did this, explain though, because I don't know if everyone knows. You did this deal with Blue Owl, which is one of the big credit providers in the country, for worth about $5 billion, right? How does that work?
Yeah, the way it works is they contract with us for a specific type of credit they want underwritten. We go out and generate demand for that underlying loan. We then fulfill that loan, and they take the loan away from us within a couple of days. So it's very capital light. We don't retain any credit risk, and we don't retain any capital requirements. It's something that we're doing on their behalf that we would not otherwise do for ourselves, either because we don't want that level of volume or that credit box. We actually turn down in a year over $100 billion of loan volume. We only fulfill about $20 billion ourselves. So that over $100 billion of loan volume, other people would like to have. We focus on a high-end customer that's 680 and higher, average FICO score around 750, average income around $150,000. But there are many of other people that have the need to invest in assets at a lower credit spectrum, and we're helping them do that in addition to some volume in our credit box that's above and beyond the volume we want to do. So it's a high margin revenue stream. It's fee-based, and it doesn't retain credit.
So these are great comments from the CEO, but I think it reinforces SoFi's long-term strategy that they don't necessarily care about profitability. It's great to see the company profitable, but at the end of the day, where they are trying to get to in the future is achieving much higher member growth. And ultimately, what we will see from that is a lot stronger bottom line numbers, but in the short term, we may have to give up some strength on the bottom line to continue growing their top line and their member count. But I want to make sure that I am fully transparent with you guys because I do own SoFi stock, and that is why I am so bullish on the company. This is the YouTube portfolio. It's currently sitting at a value of $65,095.04, and year to date we actually have a return now of almost 13%. And with Google's recent move up, all of our positions are now in the green. SoFi, we hold 200 shares of the company in this portfolio, and right now we are up over 130%. I also have positions in Super Microcomputer, AMD, Microsoft, Adobe, Visa, PayPal, Alibaba, Palantir, and Apple. Right now, I'm not really looking to add to my SoFi position. I think below $10 or even around the $10 mark is a very nice price to enter into this company at. However, with the current price sitting around $14 a share, I think it's probably trading around a fair value right now. But as I always say, don't buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. Thank you guys so much for watching. If you want to support the channel, drop a like down below and subscribe for more videos like this one. And as always, have a wonderful rest of your day. And for the joke of the day, why should you borrow money from pessimists? Check the comments down below for the answer. Thanks for watching.